Good evening. This is Ken Long from Tortoise Capital Management. Well, Happy New Year with a look at the daily trading plan for the next market open. We are in bull quiet mode, high end of neutral on an annual basis, slightly overbought on a 10-day basis. Slope of the 50-day moving average and the percent stretch above the 200-day moving average are both exceptionally strong. ADX is at an exceptionally strong 27.8 and continuing to rise. At 0.56%, the ATR percentage of the market is extremely quiet, historically low quiet. As you can see on this chart, volatility has just disappeared as we get to the end of the year. You can see ADX has flattened out here at around 27.8, and so that's starting to look a little long in the tooth, and this being a natural place to take profits in the winners from this year's up markets. No patterns per se in the gap stat. The average intraday best move remains 2 1/3% in SPY. No signals in overreaction, but there is a signal in the channeling rules for IWM. That's a good thing. The small caps have been the strength leaders, and so a channeling opportunity is a way to get back on board. Pivot point for SPY for next market open is at 125.65, so it's still 2.5% above critical support at 123. We have a whole host of 551W patterns in a lot of the names that we recognize: Alcoa, Cat, Home Depot, Kraft, and Coke, and triple screen setups in Lowe's, Cree. Those are noticeable ones to me. In the Max Pain, I'm looking at American Express, Merck, Intel, 3M, and Microsoft, and India, biotechs, internet, and regional banks once more among the ETFs. In the daily tactical, let's explode that up a little bit so we can see it. We had strength in AXP, Home Depot, and Alcoa on Friday. Looking for additional momentum opportunities there. So we'll keep that on our short. They'll keep those on our short list. And AXP especially is of interest to us because it's a 10-day max pain, but it's a 3-day min pain, and it was a strength leader on last Friday. So that's an opportunity for continued momentum. Inside the ETFs, it was all the commodities and precious metals, along with natural gas, at the expense of the broad U.S. indexes. You can see by the 52-week index how many are overbought on an annual basis, and then how many are still overbought on a 10-day basis. You can see here that the internationals and the commodities were the winners at the expense of the U.S. sectors. That could be a little portfolio rebalancing, more likely just some tactical trading because of the low volume going into the holidays. Taking a look at the Dow tactical patterns here. And we can see that there was 10 dojis on Friday, and channeling signals in Johnson & Johnson and Merck. Lots of 551 patterns for us to look at. Home Depot, Merck, Microsoft, Procter & Gamble, and Travelers. In the ETFs, not as many dojis, no patterns other than just the usual Max Pain candidates. Max Pain range compression, looking at XLV and consumer staples XLP leading the way there. Inside the Elder Safe Zone pattern, the channel finder, if you will, measurable weakness in small caps, both the growth and the balanced, and then improvements in emerging markets, Latin America, Chile, and Taiwan. These are the first signals that we've seen in almost 5 weeks that relative strength is improving globally at the expense of the U.S. So it's just the first signal, but it is something that presents us with an opportunity for sector cycling if we continue to see that. So with the U.S. at the end of a second leg up at the end of the year, and having had a period of extraordinary strength at the expense of the globals, this may be simply the first step back. So we'll be watching for the rebalancing potential in the month of January. For some supplementals, again, you can see the strength of the regression line in SPY, and the pullback of the last couple days has caused the slope to flatten out a little bit right at the +1 standard deviation mark. It's come back to its own 10-day moving average. A crossover of that line of the 10-day moving average at a distance of 1 standard deviation away from average can be a signal for a retracement. Now, if you take a look at the last time it did that here, we can see that there was a 5 to 8% pullback in SPY, and when that happened here, there was another flattening out, although that was flat more than a pullback. Going back about 4 months, we saw there was another 8% pullback. So this would be the first sign of what a 5 to 8% pullback would look like. So we're going to be sensitive to that. And then because the ADX is at a relatively high level at 27.8 in SPY, we know that it's already been a significantly strong upward trending move, as you can see on the price target here. So we're going to be very careful about adding too much more to the U.S. right now. We're going to be honoring our stops. Inside the quality report, I like to look at the divergences on the 30 and 60, and what we're seeing is Merck, Verizon, General Electric leading the way. Still some possibilities here in Boeing and Bank of America. At the high end of strength of 2 months ago, AXP, ExxonMobil, and Intel were strong but have been hammered pretty significantly. Inside the ETFs on the quality, looking for divergences remaining in U.S. real estate, oil, mixed commodities. Those are still strong potentials. I personally would be looking more at Brazil and the utilities here because they were red on the 2 month and yellow on 1 month, and that says that there's still more room to run. Those would be the stealth candidates there, and I like Brazil, Latin America, and the utilities as alternates to the strength that we've seen in the U.S. So it would not surprise me to see those becoming the new strength leaders in the month of January. There we go. See if we can get 10 per page.